Stephanie. Thank you so much for joining Fem Founders Live. It's nice to have you on the show.
Thank you for having us.
Yes, great to see you, Tessine.
Great to see you too. So, to everyone who is eventually going to join this call, so sorry we started late. We're just going to jump right into the conversation so that we can get all the questions answered. Okay, I think I would like to start by asking you to introduce yourself to us. Who is Mary and who is Stephanie? What do you do?
I am Mary Thomas. I am obviously in partnership with my sister. We are the Sales Tax Sisters, and we also have another sister firm, Thomas and Thomas PC. We specialize in SALT, state and local tax. We have both been in that space for about 20 years now. So
Ooh.
yeah, so right now there's a lot going on in the salt arena, and we are just doing our best to get the word out so that people get a baseline understanding of sales and use tax and how it impacts their business.
Amazing. Yeah, I would like. Do you want to introduce yourself too?
Yes, I am Stephanie Thomas, obviously the younger sister because I just let her go. And I, I am a CPA, and she is a CPA and attorney as well. And mostly, pretty much my entire career has been devoted to sales and use tax compliance. We help people understand their sales and use tax responsibilities, as well as research and audit representation with the miscellaneous taxing authority. And it's been very interesting, especially with the advent of new tax laws and how everything has expanded due to Wayfair. So it's been an interesting field to be in for the last umpteenth years. I'm not going to say how many. She already mentioned it.
Yeah, it's over 20 years.
Yeah.
Wow. So you guys, you've been in the industry. You ladies have been in the industry for such a long time. So obviously you have a lot of experience and you're going to share some of your knowledge with us today. So thank you for joining Fem Founders Live again. My first question. So I'm not an accountant. I'm not a bookkeeper or a tax consultant, but I've heard quite a bit about sales tax. But I've never heard anything about taxable purchases. What are those, and why do we even need to learn about them?
The thing about sales tax is it's all very intuitive, and it makes sense if you just kind of sit back and think about it for a minute. Sales
Mm,
tax is all about the state taxing authorities. They're going to get paid. So when you make $1, they will impose a tax, and they'll say, I want 10 cents of that dollar, or I want 8 cents of that dollar, whatever your tax rate may be. So when you talk about sales and use tax, that's just on a very basic level. If I go to Office Depot, which is right up the street,
mhm.
and I buy office supplies, where I am located, I'm going to pay 8.25% worth of tax. We all
Yeah,
see it, it's on your receipt. Okay.
yeah.
So that's sales tax. Use
Mhm.
tax would be if I bought the same office supplies, but my vendor, instead of being Office Depot down the street, it's a small vendor that offices in California. They don't have any Texas locations, and they're not registered to collect Texas sales or use tax. Okay. So
Oh,
if
okay.
I get those same office supplies from the person in California, they're going to ship them to me. And they're not going to charge me any kind of sales or use tax because California tax isn't due. I'm not in California. Texas tax would be due, but they're not permitted necessarily to collect that tax. So it used to be that sometimes people would inappropriately buy the office supplies from the California vendor and not remit to them at all. It wasn't charged on their invoice, and they didn't declare it to the state and give them the money. Well, I don't get a tax break because I used a vendor in California instead of a vendor in Texas. Are you
Mm.
with me?
Yes,
And
yes,
so, and
yes,
so
yes.
what I would have to do is I would have to own my Texas sales and use tax return. This is where we get the taxable purchases. In the
Mhm.
box on that return, there's a line that says taxable purchases. If that vendor doesn't charge me the appropriate use tax because I used the product in Texas, I am responsible for declaring the value of those office supplies on my return and giving the state the
Wow. Ooh.
piece of it that a lot of people miss. We see it a lot when companies get audited is they bought something online that if they had purchased it from a vendor in Texas or wherever you are, it would have been
Yeah.
taxable. But because you bought it online from somewhere else, that entity did not charge you tax. They may not have charged you tax, not because tax wasn't due, but because they weren't permitted to collect the tax and give it to the appropriate taxing authority. And when that happens, it's your job to do it. And so within that, so that's why taxable purchases are important. They're worth a lot of money in audits because if you have a zero balance as relates to tax purchases, month in, month out, year in, year out, based on the way the world works, the taxing authorities know that you don't know what you're doing because there should be something normally. And just to give you an example, we just got done with an audit where a client bought substantial values of computers from an out-of-state vendor, and the auditor came in and said, hey, we're going to tax you on this. We saw the invoices and there's no tax on them, and we know that you use those computers here in Texas. We're going to charge you the use tax. And we said, oh, no, you will not, because there was a taxable purchases number that appeared on one of their sales tax returns. And these people had a spreadsheet that said what comprised that number with the invoices that backed it up. And those invoices showed that those
The
computers,
appropriate use tax was accrued.
yeah.
Wow. Wow. my, my mind is blown. And okay, so as an accountant, how do I know if my clients are reporting taxable purchases? How do I know that they're actually reporting it?
One easy way to know is if you are reviewing their sales and use tax returns, if they are, if just like Mary said, in Texas is line number 3. If it's 0 all of the time, you know they are
Mm,
not reporting taxable purchases. That's the quick and dirty way to know if they're not reporting it. Another thing that you can do is look if you're handling their federal income tax returns. If you see purchases of equipment, that is a red flag where, okay, they're making some big purchases here. Was sales tax charged on those purchases? If it wasn't, then did they accrue use tax? The big takeaway is that if you are ever audited, the auditor will have a taxpayer history and it will list out total sales, taxable purchases. If they consistently see 0 all the time for taxable purchases, they know you don't know what you're doing. Every business, taxable purchases, because just the way the world is working now, you make purchases online
yeah,
all the
all
time,
the time. Yeah.
all the time. Every vendor is going to charge you sales tax. The other kicker is not to throw anybody under the bus, but I have seen a huge online seller whose name rhymes with Bamazon charge sales tax, but not charge the correct sales tax.
Mm,
And taxable purchases and use tax is not just about whether or not tax was charged. It's about whether or not the appropriate tax was charged. When I was running across this issue, that online seller was only charging state tax. Well, you also have city tax, county tax, MTA taxes, special purpose district taxes. You have to not only determine whether or not sales tax was due, or should I say use tax was due on this taxable purchase, but you also have to make sure that if someone is charging you sales tax, they're charging you the appropriate sales tax. And if they're not, you need to make up the difference with the taxable purchases and accruing the appropriate use tax.
Wow. So why should I care about that as an accountant, right? Some people believe that the reason why certain clients hire tax consultants or tax accountants is because they are looking for ways to reduce the amount of taxes they have to pay anyway. So why should I, as an accountant, care if my client reports taxable purchases or not?
There are a number of reasons that
Yeah.
when you are your client's trusted advisor, they feel like you're covering them. They feel like they can go to you and you will tell them the hidden gotchas. When you have a situation, or when your client has a situation and they're being audited, and when they get that letter, that is a look back at what has already occurred. So you're not going to get a chance to cure it. It is something that you're looking at, transactions that have happened in the past. If you have a situation and your client didn't collect sales tax from their customers and they were supposed to, you can always call up your customer and say, hey, I should have charged you sales tax. I didn't. Would you reimburse me?
And sometimes that happens. Sometimes
yeah.
you'll be surprised. We've run across clients where they didn't charge the appropriate sales tax. They got audited, and then the taxing authority said, listen, you should have charged this amount. You didn't. And the client has the option here in Texas to go back to the customer and say, I didn't charge you the right tax. Can you pay this? And
Wow.
you'll be surprised. Sometimes they actually do
Sometimes they actually do it.
I think in most jurisdictions you have the ability to do that. But the thing about it is that if you have a situation where a auditor has clocked you on taxable purchases, you can't shift that to anybody else. You bought that, you used it, it was taxable, you didn't pay the tax, and you have to pay it now. So not only are you looking at the tax, you're looking at interest, because states rarely waive interest, and potentially penalty. Now, penalty can be waived. It all depends.
Yeah.
But you're looking at, and if they don't have the money, it boils down to anxiety. Because if your client doesn't have the money for the tax just sitting there, they're upset because they're like, where am I going to get this money from? And they feel like they didn't know the true cost of whatever it is they were buying, because now you're talking about, depending on where you are, an additional 10%, an additional 8.25% in California, additional 14% in some instances.
Yeah, and and the statute of limitations for sales and use tax compliance is 3 to 4 years. So when you start thinking about that add up.
And so in addition to the client's anxiety about, do I have this money? Can I pay this now? You also have situations where you, as the trusted advisor, the accountant, the bookkeeper, you also have anxiety, because I've sat in with various conversations and tried to calm people down, because they will have a meltdown and start talking and start saying, I thought I was covered for this. I don't understand why my accountant, I don't understand why my bookkeeper didn't catch this.
Yeah.
I'm paying the fees. I expected them to understand and be able to catch this. And we talk to accountants and bookkeepers all the time. And one of the key things that they always say is, we don't want to do sales tax. And my answer to that is you don't have to be an expert at it. You just have to know enough to say there's an issue here and bunt it to somebody who does actually do it. In addition to the conversation, which is very uncomfortable, of, I thought you covered me for this, because even if it wasn't in your scope of work, when I take on a client, I feel like I'm part of the team. I've never met an accountant or a bookkeeper that does not feel like they're part of the team. You want to feel like your clients are getting value from you. And this is a black eye, because after this happens, you have this nasty conversation, you kind of look at each other cockeyed for a while. And if you're really unlucky, I know that I was talking to one of my advisors about a client, and I was saying, they've really gotten taxability twisted, but they actually had someone advise them on the taxability of what they are selling. And this person said, well, if I were you, I would encourage them to file a lawsuit because this taxability was wrong. It was always wrong. You're not going to get out of it. And I just said, well, I don't do the whole lawsuit thing. I don't encourage that because, to me, it's not fixing it. To me, it's just adding another layer of stuff. And I know
Yeah.
here in the Fifth Circuit, as an accountant or a bookkeeper, we're not liable for the tax, because the tax isn't our liability. But there are things I don't really like to go there or think about that. But one of the things that you want to be aware of is all you need as a bookkeeper and accountant is to just have a basic framework to understand that when a transaction is happening, unless that transaction is exempt for some reason,
Mm-hmm.
the state taxing authority is going to get paid on some level. They are going to be paid. You have to figure out, where's the payment taking place? Is it
Mm-hmm.
is it at step A? Is it at step B? Step C?
Yeah.
They're
Mm-hmm.
getting paid
Somewhere.
somewhere. If it's an exempt transaction, they're getting paid somewhere. And if exempt transaction, then you get into a whole nother kettle of fish because you're going to have to prove it. Because remember, state wants to be paid, and so that's what
That's
it's
their
all
thing.
based
Yeah.
on. So if you're going to come up and say something is exempt, you better be able to prove it, and you better be able
Mm-hmm.
to prove it to their satisfaction. And there are always rules that are set up that will tell you how you prove it to their satisfaction. So with taxable purchases, I would tell anybody as a bookkeeper, an accountant, you care, not only because it's a potential black eye for your client, it's a potential black eye for you too. Because depending on how much money that is, oh my gosh, people will start looking at you and start questioning that relationship
Mm-hmm.
based on the feeling that you didn't cover them, whether that impression is true or not. Because we all know sometimes our clients get away from us. It happens all the time. They don't always tell us everything that they're doing. We find out
Yeah.
later.
After the fact.
Yeah. So you just have to kind of try to keep your finger on the pulse of what's going on and just be aware of what your client is doing as best you can.
Wow. Ooh. Okay, yeah. So yeah, because I mean, I feel like if my accountant or bookkeeper, misses an important detail like that, somehow it's going to put a strain in the relationship. I
Exactly.
just I just will not trust you as much. If I eventually leave you, I may not tell you everything like you said, but I'm going to tell a friend or a colleague, and then your reputation is at stake. So
Yeah.
I totally understand that. So in your experience, have you seen clients face material cash flow connected to this area?
Yes, because just like you hadn't heard a ton about taxable purchases
Yeah.
beforehand, a lot of business owners don't know about taxable purchases. So if they're going around and they're making huge purchases, for example, of equipment or renovation
Hmm.
or just other fixed assets from out of state vendors or even vendors in the state where they're doing business, but the vendor did not know the correct taxation. That can come and bite them later on, especially considering that it is a 3 to 4 year statute of limitation here. And
Hmm.
so when you add, $1 million expansion to your commercial space, but the contractor didn't charge you sales tax on anything, hello, that is not a place you want to be. The same thing as it relates to equipment, because I've seen lots of clients where they were making purchases of equipment online from like eBay and auction houses and stuff like that.
Yeah.
And the vendor didn't charge them any sales tax. They weren't thinking about accruing any use tax. And then you get that lovely letter from the taxing authority that you're going to be audited. And then you look out and you're like, oh, I got all this equipment. Well, you didn't pay tax on it. You didn't pay any sales tax on it. You didn't accrue any use tax on it. And so that can add up, especially when usually equipment isn't cheap, especially if you're, ramping up to do various different things and there are no exemptions relating to the equipment that you purchased. That can be a big gotcha.
Yeah,
But
absolutely.
there's so much to it. A lot of people have gotten better about charging. A lot of people have gotten better about charging sales and use tax because of Wayfair and the fact that people are now aware of a lot of those responsibilities. But I find that a lot of people spend a lot of time on the sales side and they don't think about the purchases side.
Mhm.
And what they do inadvertently is they rely on their vendor to know the taxability and to handle it appropriately for them. And depending on how much money is involved in a transaction, that could be a very dangerous thing. Just
Yes.
just like you're trying to figure out taxability and taxation, so is your vendor. And sometimes they get it right, and sometimes they get it wrong. And so, and if they get it wrong, then typically sales tax is the liability of the purchaser. Now, the state can go after the seller or the purchaser, but it is ultimately the liability of the purchaser. And one of the things that we talked about in terms of taxable purchases is when Stephanie was talking about the purchase of equipment. I've noticed when you said, have you seen it become material? I noticed years ago that we had a really great client who they bought equipment. And remember when I said the state wants to get paid and they're going to get paid somewhere?
Yeah.
These people bought equipment. They did not pay sales or use tax because they issued a resale certificate. When they originally bought the equipment, they bought the equipment with the idea that they were going to have a rental fleet and they were going to rent this equipment to third parties and they were going to collect the sales tax when they rented them to the third party. So keep in mind, the state was going to get paid somewhere. So sales and use tax is a transactions tax. So the first transaction between my client and the person that sold them the equipment, as transaction one, that transaction didn't get taxed because my client issued a resale certificate that said, don't tax me, I'm going to resell or rent or lease this equipment. The second transaction would be between my client and whoever is renting the equipment. So that's where the state would get paid because my client was going to tax the people who were renting the equipment. So think about that. That's where they got paid. This is where it gets dicey. These people decided, you know what? We can make more money if we actually provided the service sometimes. And, in addition to renting the equipment, they can hire us to actually do it. And so what happens after that particular instance is you're using the equipment that you got tax-free because you said you were only going to rent it to third parties. You're using it yourself. Do you see what happened there?
Yeah.
The use of that equipment, the fair market rental value or the use of that equipment became subject to sales tax, became subject to use tax because it's called a divergent use. They didn't use it in the context of resale. They used it for their own consumption. And that became a really big issue. So depending on what your client is doing, depending on when they decide to expand their business, to expand their line of service, you have to always look at, is it taxable? Is it not? If we claimed an exemption, does it work? And just always remember, the state is getting paid somewhere. Somewhere, at least one time, they're getting paid. And I tell you a dirty little secret. Sometimes they get paid more than once. so,
Mm.
so so can it be material? Yes. Is it material for everyone all the time? No, but it's something to keep your eye on. It's something to really think about, because something else that is going on, when Stephanie was talking about the nature of business these days, is that here in Texas and in other places too, the use of apps is subject to tax. And so you have all these people coming up with all these wonderful apps. And it used to be that you would get these invoices and there wouldn't be any tax on them. And you're like, we're going to have to remit that directly to the state, because there should be tax on here. Yeah. I am amazed and horrified by how many people don't know that they should be paying tax on the usage of those apps, depending on where they are. And
wow,
talking about big companies, it can start getting big. So you always have to pay attention to, don't always rely on your vendor to know. Sometimes they don't. So it's apps, computers, and software is another thing. Yeah. And construction, like Stephanie was talking about construction, oh my gosh, if people really knew the true cost of getting things renovated and remodeled, some folks would do it. That's hundreds of thousands of dollars, if not millions of dollars. And when you talk about, 14%, 8.25% on, unbudgeted, because you weren't thinking about the tax ramifications, talk about eating ramen noodles. It can just get insane. And those are horrible conversations to have with people where they're like, well, what? I had somebody ask me, what, did we get a good number? And I'm like, no, you didn't get a number. We talked about this. You knew you weren't going to get a good number, because this material vendor did not bill you the tax, because verbally they didn't think they were supposed to, and you didn't accrue it. The auditor ID'd it, tagged it right away, and we all knew it was material. So I always tell people, if you are engaging in a transaction that is worth a lot of money, you're spending a lot of money, and you know that you can't handle a bill associated an additional 10, an additional 14, additional 8.25%, have somebody look at it.
Look at it. And not only that, not to interrupt you, it's not only the big dollar amounts, but high volume transactions as well, especially when you're dealing a lot with out-of-state vendors for a large volume of transactions. It's not just the huge big ones and just in terms of dollar amounts, but if you're getting the same transaction, recurring transactions over and over again, that'll add up too. So you need to make sure they are handling the sales tax correctly. And if they're not, you need to handle the use tax correctly.
Yeah.
And is this only applicable to business clients, like business owners, or also to individuals?
Oh, that's a good question.
Well, I'll put it to you this way.
Okay.
States will generate audits of individuals, usually high net worth individuals. It's rare. You have to think, states, remember I told you it's all about the state getting paid.
Yeah.
The state is not going to come and audit me, Mary Thomas, for my 99-cent iTunes
download.
It doesn't make any sense for them to pay somebody to come and audit me for, because when I go to the grocery store, I'm paying the tax.
Mm-hmm.
When I buy something from the mall, or a store that's in the mall, I'm paying tax.
And those instances where she may be purchasing something online, it won't rise to the occasion money-wise for them to say, well, let's generate an audit of Mary. Because no, she not balling like that, okay? So but focused on high net worth individuals.
I will say there's one question that I did get, and the genesis of it was the audit of a business. A lady called me up and she said, my company's being audited, my boss's company's being audited. I'm dealing with the auditor, and he ran a personal expense through the business account, and he did not want to turn this information over to this auditor because it was personal. And the auditor didn't take this lady's word for it. And she said, the auditor is talking about generating an audit on this man personally in his name if she doesn't give this auditor the records. And she asked me, could this auditor do it? And the answer is yes. She can do whatever she wants. So after we got off the phone, as we're talking, I'm like, give her what she's asking for, so she does not
generate an audit personally.
Yeah, they can't audit you personally, but it's so rare.
It's rare.
It's usually high net worth individuals. It's usually something weird, in my opinion, going on that would make somebody generate an audit like that. Usually it's businesses. And usually the only time that your personal expenses would get thrown into the pot of being looked at is if you use a company credit card or you somehow expensed that personal expense in a way that is showing up on the GL. Then it's fair game that the auditor would look at it. That's why when I'm in the store or if I'm doing something, if I'm posting something, if it's a $9 charge, a $2 charge, and I know I don't want to keep up with that receipt, guess what I use? My personal credit card. I don't use a business one because, they're not going to generate an audit of me. And, if I'm in the postal place, at least postage isn't taxable anyway. But, that thing about it is that what you want to do is just be really careful about not mixing. And regular Joe blow out on the street. Are you going to generate? Probably not. Probably not.
So you're safe, Josine. You're safe.
I'm safe.
Well, you're in Canada. Just always remember, the state is all about being paid. They do a cost-benefit analysis, just like everybody else. And it just didn't make a whole lot of sense to go out and audit people that individuals that just you aren't making a whole lot. It's not a whole lot.
That makes sense. Thank you. I think my last question is so what are some of the things I as an accountant can do to address the issue if and when I recognize it?
So we decided to do this in round robin. So I would say the first thing you want to do is you need to determine the statute of limitations for where your client is. It usually ranges between 3 and 4 years, absent of finding a fraud. Once you get the lay of the land of, and you know the dates that you're looking at, go in and ask for key documents so that you can determine and start quantifying if there is an issue, how big it is. And some key documents that we like are the federal income tax return.
Yeah. That's one document that, even though it's a state audit, state auditors will look at because they're looking to see your depreciation schedule. Have you had, are you capitalizing equipment? What fixed assets have been added? So there are various different roadmaps lead them to whether or not you have potential use tax exposures.
Yeah. And one of the things that I am really beginning to tell people, although people look at me like I'm crazy when I say it, if you have expense statements from different people, if you have issued company credit cards, you need to go in and make sure that not only you have a procedure that is going to capture those receipts, make sure that you have them. There are so many things that people can do now in terms of taking pictures of receipts on the phone and uploading it into the cloud. There are a couple of apps where you can take care of having repositories of different receipts. I know that when I go into I think it's Office Depot, Home Depot, both of them, where you can say, when you buy something, you can say, I want a paper receipt and an email receipt.
Yeah.
Keep keep the documentation as to what you're spending. Because here's the thing. If you get audited, the only thing that auditor wants to see is a receipt that
With a
says
separately stated sales tax on it.
or something that says sales tax was included. Once someone takes on that fiduciary responsibility that you have given them the tax, and it becomes their responsibility to turn it in. That's why when we tell people, when you know something is taxable and your vendor has not charged you tax, don't just write tax in on the invoice and send those people that money. Those people may not be permitted to collect sales or use tax from you.
And if an auditor sees that you did that, they will say, oh, that's a nice tip that you gave that vendor because we never got that money. We don't know if we got that money. So we're going to assess tax on it again. So that's one reason why if you see that the mom and pop operation is not charging you sales tax, don't just say, oh, you should have charged me sales tax. I'm just going to write it up and send it to you. The state doesn't know if they got that money. So if you get audited, they're going to assess the tax again.
And that's another gotcha for people, is that sometimes it's very common that people will hire small companies or people that they know and like to come in and clean the office or to take care of the lawn, do little piddly things, because people like to help people out when they can.
Mm-hmm.
If you're doing that in a business context, you better make sure that you understand whether or not those services are taxable. If they are taxable and those people are not permitted, and it's normal for some of them not to be permitted because they just know they're good at cleaning, they're going to go make a couple extra bucks. If they're not collecting the tax from you, that does not mean you don't pay it. That means that you remit it directly to the state. So that if it's ever looked at, if your books are ever audited, you don't have that liability sitting out there. And that is very common. That's very common to see.
It is. That's an area that one of the areas down here that she was talking about is janitorial services, which are taxable. And there are certain areas where an auditor will always hit that account to make sure that either sales tax was charged or you accrued the appropriate use tax. So that's one area there. And I know Mary mentioned this, but I want to focus in on it a lot one more time. Make sure you retain your records. And for the statute of limitations, which is normally for sales tax 3 to 4 years, depending on the jurisdiction where you are, because if you don't have your records, that won't stop an audit. They will estimate. You do not want to audit estimates. So it's never in your favor. So just make sure you retain your records, your work papers. They want to know how you came up with the numbers that you reported. That is very, very important and something that everybody should do.
Just remember when I was saying with the example earlier of the client that bought the computers, the only reason that tax peeled off of that audit, and it was material, was because they had accrued the tax. And they had the taxable purchases number, which the state knows what you report as taxable purchases. So they had a big number sitting out here as an accrual, and then they had the backup, the spreadsheet along with the invoices that showed, hey, we actually accrued and remitted the tax on this previously, and it just peeled off of the audit. So what you want to do is you do want to have the documents retained. You do want your source documents, your receipts and all of that. You do want to have how you calculated the taxable purchases and keep all of that. And that's part of the question of if we think there may be an issue, what do we do? Well, you determine the statute of limitations. You're going to go back and look at their returns. Go back and look at their work papers and see what they have accrued tax on. Go back and look at the federal income tax return and see, ooh, they bought this equipment during the statute of limitations. Was it taxed? If it wasn't taxed, why wasn't it? There may be an exemption.
Sure.
You just need to document it. Go back in and look at the fixed asset accounts because that's a big account of interest. Go back in and look at the expense accounts. Like I said, the expense accounts and the credit cards. Because what I have found too is that a lot of people will be really proud and tell me that they have the receipts for the restaurants and all of that. They're showing me the receipt that says that they paid $60 for the meal and they left a $10 tip. Well, that's on the credit card statement. I need the receipt that says that Richard had the ribs and Stephanie had the chicken. It cost 50 something dollars, and there's like $8 the tax on here. That's the receipt that I want. I don't care about the tip.
Yeah.
I care about the fact that that receipt that shows exactly who ate what. That's what tell me the sales tax was paid. And that is what is going to get an auditor the ticket paid and move on. Something that we've noticed is that there are companies where they collected tax, and you'll have an auditor and they're doing their job. And I can't say I met one that I didn't care for. We usually get along like gangbusters. I looked at one of them one day and I said, "Hey, why you got this Walmart item on here? You know Walmart charged tax." And they said, "Yeah, I kind of have a feeling that they did, but I got to see the receipt."
You got to see the receipt.
What can I say? I mean, really,
Yeah.
what can I? Because when you think about it, it is the unique responsibility of the purchaser to have those receipts.
Yeah.
And that's why it's a really good idea that, especially because we're in Houston, so there are people in Houston, there are people in California. They get wildfires, Florida hurricanes. Oh yeah, Richard doesn't eat ribs. Sorry, Richard. Salad. But what you want to do is also consider having your stuff up in the cloud. We just had a client who was audited.
And it was a hurricane or tropical storm or something. The records were all mushed and destroyed.
Yeah, and not only were the records destroyed that our client was holding on to, the vendors' records were destroyed too, because they kept them somewhere that was low to the ground. And so when I called and said, "Hey, do you have the records?" They said, "No, ma'am. They were destroyed in the storm." And that brings me to another point too.
And that won't stop the audit.
No, it won't
stop the audit.
No, that transaction tax was just paid on the beginning. But this is another thing too, when you recognize that there may be an issue, or you recognize there is an issue. Even if your client doesn't have the records on hand, there's a workaround. If the vendor has copies of the invoice, and they typically do, you can get them that way. But with that backdoor thing, it's best to do that as close to the actual transaction as you can.
Yeah.
Because people are always, and I know I'm like sometimes I can be a big old dinosaur. When people say that they have changed accounting systems, it strikes fear in my heart, because typically what that means to me as a SALT person is they don't have access to the invoices that they issued. If they don't have access to the invoices that they issued, how do we know tax is charged? How do we prove that to the taxing authority that they got every nickel that they were supposed to get based on the provision of the invoices?
Yeah.
We can't if they're locked up. No. And you would be amazed at how many people do that.
Yes, and they'll do it after like 2 years, and the statute of limitations is 3 to 4 years, and you're like, where are your records?
Yeah, and they'll tell you, and this is my nightmare story. The audit was 4 years, right? They changed accounting systems in year 3. So I had a whole year with no records. And I'm sitting here and I'm like, okay, so I'm not upset about this because you have access to the old system, right?
Yeah.
Well, theoretically we do, but the only person who knows how to get into it is Mabel, and we don't like her.
That's right.
So we fired her 2 weeks ago. And you're like, okay, so if Mabel's gone and you knew you were going to get rid of her, she trained somebody else on how to use the old system, right? Oh no, we just had to get rid of her real fast. I'm like, well, what do I do about this year? And they're like, we don't have it. And I'm sitting here like, you're gonna pay tax on everything this auditor schedules
Yes.
for this period of time.
Yeah.
We gotta find a workaround. So I always tell people it's great to upgrade, it's great to go into the cloud, it's great to streamline your processes as long as you don't obliterate your audit trail.
And you have to keep an eye on source documents. Source documents are the most important thing.
Yeah, and make sure that your source because this is, and we were talking about this the other day. The source documents being your receipts, your contracts, your purchase orders,
Your invoices.
your invoices, because we're coming at this from the side of taxable purchases. So you're going to have invoices and contracts for the things that you're purchasing.
Mhm.
Make sure that you have all of that so that if somebody comes in and looks at it, the summary totals should be the roll up of those discrete transactions.
Yeah.
And so it's just very important. If an auditor comes in, this is what they do. An auditor will come in and say, I want to see invoice 1234 from company ABC. Yeah, you got to be able to produce it.
Yeah.
You got to be able to, and if you can't produce it, or if they find an error in it, they can do a sample and projection. They can keep digging as long as they want to. And we were laughing about this too. Now, with the advent of all the apps and everything being automated, guess what? They don't have to sit in a warehouse of nasty records and have
And dig through boxes. No.
Yeah, and have a materiality threshold of if it's less than $100, I'm not going to be bothered. They don't have to do that anymore because everything is on their computer. Now we're seeing materiality thresholds of a penny or $1. So it's everything. So that just heightens the fact that you have to have the information, you have to have the source documents, and just having the summary documents, the summary totals, that just makes it easier. Because guess what happens? They tax the whole number and then tell you, prove me wrong.
Yeah.
And we're seeing that a lot. Be it bank statements, sales numbers. We're seeing that a lot.
Wow. I keep saying wow because it's just it's been an amazing conversation, very eye-opening, very very detailed, very interesting. Thank you so much, Stephanie and Mary. Thanks for joining me and thanks for sharing all this important information. I'm going to be sharing this with our community, and I know that many people will get so much out of this. Do you have any last words about the topic before we end the conversation?
I think I would just tell everybody to just, instead of saying, I don't deal with sales tax, just take a deep breath. You don't have to be an expert. You only have to have an idea of the basic framework of how it works so that if you want to call somebody else in to really nail it, you can do that. Just take a deep breath. It's all about making sure that the state gets paid. And once you calm it down and you think about it in those terms, it gets a lot easier.
It does. And don't be intimidated. Don't be intimidated by it. And also, it's always good to know that you don't know everything. There are resources out there to help you. So you can help your client and look good. So just take a breath and just say, okay, I'm not the expert on sales and use tax. There are other people out there, other avenues that I can use, other resources I can use to help my client. They'll appreciate it.
And at least mention it. If your client decides not to move on it, if something happens later and they say, you didn't tell me, you can say, but it did. But you didn't want to do anything with it. And in that way, you don't lose any face or anything. And people typically are pretty good about saying, you did tell me that, and I just didn't do it.
Yeah.
Absolutely. Thank you so much
Thank
again. And thanks to everyone who joined on and off throughout the conversation. I am Tosin. I work with Financial Sense. Financial Sense is a practice management software for accountants, bookkeepers, and tax firms. We help you to get work done. right? So from scheduling your work, tracking your work, managing your clients' information, organizing everything in one place, and collaborating with your staff. Financial Sense is your go-to for that, so that you can just automate all your work and you can focus on spotting taxable purchases for your clients and saving them from paying huge sums in fines. So thank you again, Sales Tax Sisters, and I look forward to having you back on the show in the future to talk about another aspect of sales tax.
We'd love
We
to.
love to. It's nice to see
See
you,
you,
Chelsea.
Chelsea.
All right, everyone. Thank you.
Thank
Bye.
you.
Bye.